old school. Yeah.
We can go ahead and get started. I was gonna give people a few more minutes and they got a few minutes, so I'll get started. Jeff and Lynn are in Cabo right now, so that's why they're not here. So I was gonna just introduce Brady Slack, and he's gonna tell us about tax strategies today. Super excited.
Yeah, awesome, thank you. I like intimate groups. I'm actually flying to Phoenix today to go speak at a mastermind. There'll be about 15-20 entrepreneurs. The premise of the mastermind is buying and selling businesses. So lots of individuals whose businesses are doing top line 7-8 figures, and that'll be a fun one. And then I'm actually going to be in Vegas next week, and that one will be a bigger group, maybe 80 people or so. And I'm less excited for those kinds of meetings because I just feel like I'm preaching to the choir. But here, you know, there's 6 or 7 of us, so we can kind of get a little bit deeper rather than broader. When I was talking to Jeff and Lynn, I spoke 8 months ago to another in one of your other meetings, and we just kind of went over general tax topics. But I was talking with Jeff and Lynn, and it was funny, maybe a week and a half ago, 2 weeks ago, we were going over specifics about their rental portfolio and questions they had for me. And so I said, well, why don't I just talk about the rental aspect of real estate? From a tax, and it was Ashley, right?
Yep.
I was talking to Ashley just briefly as we were all conversing earlier, and we were talking about kind of the whole entrepreneurial, and that's kind of where I got my start. I'm an avid investor. Apart from my accounting firm, which I'm the principal partner of, I've got a software, a SaaS company that I'm also a partner in. We have real estate. And so I am much more business mind focused. And I know as real estate agents, from a tax perspective, real estate is one of, if not the best investments that we can make. So we'll kind of go over that today. I'm going to just leave it open. Please interrupt me, answer or ask questions. I know there's a couple people on the Zoom meeting as well. Please unmute yourself if you have a question. Stop me if something doesn't make sense. We can make this as long as you guys need or as short as you guys need. I just have a flight at 3:50, so as long as I can get to the airport by then we should be okay. Okay. When we talk about taxes, I want everyone to understand that from a tax advisor's mindset, there's 3 time periods that we want to try and focus on for strategy. Okay, obviously one is now. One is, I'll call it future, but the sale or the transaction of whatever venture we're participating in. And then the other one that we're trying to focus on is death. Now, in all my education, we didn't take any courses about therapy or life events. So I'm just going to call it death. Sometimes I call it expiration. Don't take offense to any of that. That's not kind of a harsh way of dealing with that life event. That's just the reality of things. Okay. And there's a couple different ways that all of our income, whether we're talking about business or rental income, capital gains tax, whatever that is, there's a couple different ways that our money is taxed. Now, again, when we're having these conversations, please understand that we are talking about what current tax rates are. I wish I had a crystal ball to be able to tell you that, hey, President Biden just announced a new bill and he's proposing to raise capital gains tax rates or corporate tax rate. We're not going to talk about what that's going to look like because it's speculative, right? So we will deal with what the current tax law is, and then I would advise you guys that as these events happen, as new bills are introduced, converse with your tax advisors to figure out how that's going to affect these situations. But really what we're dealing with right now, again, focusing on rental real estate. Right now, we need to be focused on capital gains. Right now, we also need to be focused on ordinary income or rental income. In the future, we need to be worried about capital gains, and we need to be worried about rental income or ordinary income. And at death, we want to be worried about capital gains or estate tax rates. Okay. And what I mean by estate tax rates is just simply the fact that when we die, our beneficiaries are going to inherit whatever it is that we own at fair market value. And sometimes those estate tax rates are significantly higher than ordinary income tax rates. Okay, right now, our top income tax bracket is a 37-39% tax bracket. not including state, okay? But the estate and gift tax rates are 40%, so inherently a little bit higher. And that's when we're going to talk about trusts and things like that, which we won't get into a whole lot today, but more than happy to have a conversation offline if anyone's interested about that. Okay. Now, the reason why, from a tax perspective, I say real estate is one of, if not the best investments an individual can make, not only from an agent standpoint, but also for your clients, when you guys do have clients that are looking for tax shelters or tax opportunities or just general investments. I know you guys were talking a little bit about Airbnb earlier. The reason is because I can not pay taxes now on my rental real estate, which we'll dive into and we'll break down for each of these. I can eliminate the tax in the future when I sell my properties, okay, if I do so correctly, which again, we'll kind of talk about in just a little bit. And then I can eliminate the taxation of my properties when I die and pass those on to my beneficiaries. Okay. There aren't any other investments where I can eliminate the tax in all three of these stages of one's life. Okay. There are other investments, there are other entity holdings, there are other situations where I might be able to eliminate a tax in one of the three areas of my life, but there's not another investment that I can think of, nor have I been able to encounter where I can eliminate the tax in all three of these segments. Okay. Any questions up to this point? Comments? No. So, how do I eliminate the tax now? In most cases, rental income is considered a passive income source, which means it is not subject to self-employment taxes. Okay. The only situation where it is, which is going to do a little bit with maybe an Airbnb, is if I create an opportunity based on my material participation and the average rental length stay for my Airbnb and maybe some substantial services, is I can create an opportunity to make it ordinary, which provides us with a tax planning opportunity. But like I said, in most cases, it is passive. Okay. But with this rental income, and sorry, I'm going to kind of crouch down and turn my back to everyone as I write this. With my rental activity, I have my rental income less any expenses that I have for this rental property, which we'll talk about in just 1 second, equals a net operating income. Okay, or a net rental income. Now, the one thing that we're missing here, and in every business that we operate in, from an accounting perspective, we always want a net operating income. I'm never going to advise a client to get into a business that is not going to have a net operating income, because that would stipulate that we have a net operating loss, and we don't want losses, right? Yeah. However, in real estate, we are given the opportunity to include, I'm actually going to use black, to include depreciation. Is there anyone here who is not familiar with what depreciation is? Everyone on Zoom okay with the term depreciation? Do they understand what depreciation means?
I go over it real quick.
Do you want me to go over it? So depreciation from a tax perspective simply refers to a cost recovery in the form of an expense. Okay, it is a ghost expense, meaning I do not necessarily spend all that money to capture all the expense, but it is a recovery of the asset. What depreciation allows us to do is it allows us to buy an asset and recover the cost of that asset over what the IRS deems its useful life to be. Okay. A useful life can be determined by how long we think that asset is going to last us before we have to replace or repair that asset. Okay. So when we refer to depreciation in a property, typically we're referring to a depreciation of, for residential real estate, 27.5 years. That's how long the IRS has deemed its useful life to be. And then for commercial property, 39 years. That's how long the IRS has said depreciation will last for in a commercial property.
How many?
39 years, which means, doing rough math, if you buy a property for $1 million, it's a residential real estate property, you can divide that $1 million by roughly 27.5 years, less the land cost. We can't depreciate land, okay? But less the land cost, and that's what is roughly going to be your depreciation expense every year, give or take, okay? Any questions on that? Did that help? Maybe clarify that?
Great, yeah.
Okay. Now, what this depreciation does in most cases is it should actually allow us to convert this net operating income into a net operating loss. And we can utilize this net operating loss so that one, we don't have to pay taxes on the cash flow that we are receiving from our rental properties. And in some cases, we can actually use this net operating loss to offset the income generated from other sources, okay? Now, as a tool, and this is what I do want to talk about just a little bit, we can have a conversation about it, is as real estate agents selling real estate, maybe some of you do own your own real estate, you guys have the opportunity to be classified as what is referred to as a real estate professional, okay? When you invest into real estate, there are 3 classifications for a real estate investor. There's a passive real estate investor, there's an active real estate investor, and then there is a real estate professional. Okay. And this is important for your clients to understand when they're investing into real estate, but I would also argue that it's important for each of you to understand as well.
Can you say those again? please?
Yep, passive,
Mhm.
active, and real estate professional.
Okay.
What is a passive real estate investor? A passive real estate investor is someone who necessarily does not have what the IRS refers to as material participation in that property. This is someone who maybe invests into a syndication or gives money to a partnership and is a limited partner in that investment. Someone who maybe is entirely hands-off or pays people to do more work in that rental property than they do. Okay. What is the tax consequence of a passive real estate investor? The tax consequence of a real estate investor or passive real estate investor is that they can only use these net operating losses from their real estate to offset other passive income activities. Okay, so someone who maybe is a limited partner in another business venture, and that business generates revenue, these real estate losses can only offset incomes subject to passive activity rules. Okay. If they have a W-2 or make commissions selling real estate, these losses cannot offset those incomes. Okay, any questions on that?
So really it's just passive versus I mean, if it's passively gained,
Yeah.
then it's passively applied.
Yeah, in accounting, we call them pigs and cows. Passive income generators and passive activity losses, and only cows can offset pigs, okay? Now, active real estate investors are someone who does have material participation in their real estate. This could be determined by outlining what the rental agreements are going to look like, interviewing renters, maybe managing the property or working with a management company to help manage the property, maybe someone doing repairs on their property. Again, it all comes down to the material participation rules and certain hour requirements depicted by the IRS, okay? Someone who is an active real estate investor is allowed to use net operating losses to offset both passive incomes and ordinary incomes or wages, real estate commissions, business incomes, okay? But they are subject to a couple rules. Those rules are if I make over $100,000, the amount of losses that I'm able to use to offset my incomes start to phase out. And at $150,000, I can no longer use passive incomes, or excuse me, passive losses to offset ordinary income, just back to passive income, okay? So when we do planning, we need to know kind of what the financial landscape is of someone, whether we've got ordinary income, whether they're passive or active in their real estate, whether they have passive incomes, to be able to determine how we can utilize these losses to benefit them. Okay? Because if they're making over $150,000 and they're an active real estate investor, we're kind of handcuffed. Okay. Don't shoot the messenger. The third classification of a real estate investor is someone who is a real estate professional. Just out of curiosity, is anyone aware of what is required to be a real estate professional? Does anyone know?
Like 700 plus hours a year. I don't remember the exact number.
You're good. There's 2 tests. That's so that you're close on one of them. Any other takers? No? Anyone on Zoom? Any takers for a real estate professional? What the required 2-part test is? Sweet. So you're close on one. So there is a 2-part test, and that's going to be the second test that we'll go over. The first part to this test is that more than 50% of the services that an individual performs in a year have to be associated to real property, trades or businesses in real property. Okay. This could include, is not limited to, title, mortgage, escrow, real estate commissions, property management, cleaning and maintenance, construction. Okay. All of those could be considered businesses in real property. The caveat is if you are a W-2 employee, you do have to own at least 5% of the business that you work for you to still be considered under rule number 1 of real estate. Okay. Rule number 2 is that if more than 50% of the services that I perform in a year are in real property, that I have to spend at least 750, you're close, 750 hours a year in real estate activities. Okay. 750 hours a year comes out to be about 14 hours a week, 15 hours a week. Okay, give or take, if you're working every year, every week of the year, excuse me. Any questions on that? What is required to be a real estate professional? The tax consequence or the tax opportunity is that I am no longer subject to passive activity loss rules if I am a real estate professional. And I can use all of my losses generated from real estate to offset not only my passive incomes, but also my active incomes, W-2s, business income, commissions, sales. This provides investors with a vast opportunity to save money on taxes. And this rule alone is what helps my clients save millions of dollars a year in taxes. I have one client last year whose business top lined at about $7 million. Total tax bill should have been right around $350,000, gets a refund for $20,000 from the IRS. Okay. The year prior to that, top line was about 5 million. Should have got about 375 because he had some gains that were in there, got a $30,000 refund. Okay. I have another client whose real estate commissions are right around 1.2, 1.3 million. Total cash flows from rental real estate. Last year, don't quote me on this, we're right around 350, 375. So total revenue, maybe 1.5, 1.6 million dollars. Total tax due was about $20,000 to the IRS. Okay, because again, these are active investors that are investing into properties and they're using large amounts of offset through depreciation to generate on paper losses to help offset their incomes. Okay. Now, we all know, or at least we should know, that we're not losing money on our properties, right? We're still cash flowing, but because of the tax law, we're able to use these depreciation losses to help show a loss on paper to the IRS. And because of the rules of real estate professional, right now, we're able to not pay any taxes on our real estate and potentially not pay any taxes on any of our other sources of income. Okay, any questions so far?
The hours, do you have to keep do you have to have a log or something that shows what hours you're spending?
Highly recommended.
And
Yeah.
then does that include like drive time? I mean, what things can you include in there? In your hours?
Yeah, meetings, emails, listings, you can include property management time, you can include repair time, you could include research and development time, you could include decorating, you could include.
How often is any of that required then? Like, because I would anticipate you would only need to prove it if it was in doubt.
There was an audit.
You're not wrong. I require that all of my clients who are filing as real estate professionals have a log and substantiate the log while we're filing the return, just so that I know that what's going on to the return I'm aware of. Because I also sign returns under penalty of perjury, right? So I need to know and understand what's going on the return. we have some PDF and there's an app, I can't remember the name of it off the top of my head, that some of our clients use. Where they can log, kind of like a mileage log, every time they're doing something with real estate, they can kind of clock in and clock out again. But you are correct, okay, those aren't documents that I have to submit with the tax return to the IRS. However, if you were examined or audited by the IRS, you would need to substantiate or prove the requirements for a real estate professional.
What's substantiation? What is it? I mean, other than receipts for.
Substantiation for a real estate professional, again, is gonna revert back to some sort of log or hour classification that you have for all of the activities you were doing in real estate.
Okay,
Yeah. And for the first test, the 50% of services performed, we're gonna really easily be able to determine that with someone from the IRS that, hey, if you're a real estate sales commissioned agent and you have rental real estate on the side, everything you do, more than 50% of the services you perform in here are in real estate. Not hard to prove that one. It's the hour log that typically comes into play a little bit more.
Yeah.
Good questions. Anyone else? Anyone else on Zoom, any questions up to this point? No? Okay,
Question.
so we've kind of gone through the now, right? Again, there's a couple people that have hopped on late. We're kind of covering taxes, how in my opinion, real estate's the best, if not the best investment for tax purposes, because we can eliminate taxes now, in the future, and when we die, okay? I want to talk about the future just a little bit. Okay, and if there are any questions at the end, we can go back and kind of review all of them together. In the future, typically when we hold an asset and that asset appreciates in value, okay, it increases its value, and we go to sell that asset, we have what's referred to as a capital gain, okay? Capital gains tax rules are subject to the time period in which I hold that asset. So if I hold an asset for less than a year, I am subject to short-term capital gains. And short-term capital gains are taxed at ordinary income tax rates, okay? Typically, we want to avoid short-term capital gains because the tax rates are inherently higher, okay? Any asset that is held for longer than 1 year, okay, it can be 366 days, it is still long-term, that asset is subject to long-term capital gains tax rates, okay? How much you are taxed is determined by your filing status and how much money you make. There is a income stacking element, if you will, meaning if I have W-2 income, business income, and a capital gains, all of those incomes will stack together to calculate my adjusted gross income. But the following 3 tax rates are associated with long-term capital gains tax rates: 0%, 15%, and 20%. If you are married filing a joint tax return, your income limitations are something like $82,000, and any amount under $82,000 is taxed at 0% on long-term capital gains. 82 to 520 some odd thousand, don't quote me on that right off the top of my head, you're subject to a 15% tax, and then anything above that is a 20% tax on your long-term capital gains, okay? That's going to be with stocks, business assets, that's going to be primary residence, that's going to be any other capital source income that you guys could hold, okay? Now, with real estate, we've kind of already gone over how we can eliminate the rental income in the future. I'll make a comment speculatively. I told you guys I wouldn't, but I will. We can assume, just based on who's in Washington, that tax laws surrounding our rental real estate will most likely not change, because the individuals in Washington and their buddies still own real estate. That's how a lot of them have accumulated wealth, no matter what side of the aisle you stand on. And so these rules will most likely not change. There are some rules that are changing around depreciation, as far as how much depreciation you can take in a single year, just based on the current tax law. There's a step down to bonus depreciation, but this general idea should not change, in my opinion, okay? The one that we
Can I ask a question on that?
Yes.
I mean, I know that some of that was cost segregation.
Yes.
Is that kind of what you're speculating on? Is that piece of it, or? Because I know there's some changes, as I understood.
Part of it, yes.
Okay.
That's, I don't think, So I'll take a step back, because this is a really good
Yeah.
question, okay? Cost segregation analysis is a very underutilized tool, in my opinion. So what a cost segregation analysis is it is an analysis that separates the assets within a home into their appropriate useful lives. And the reason this is important is because any asset with a useful life of less than 20 years can be put on what's referred to as a bonus depreciation schedule, meaning I can front load that into a quicker time period, typically 1 year, rather than waiting its entire useful life to recover the cost, okay? What a cost segregation does, like I said, is it allocates all of the different assets in a property into their useful lives. Whether that's 5 years, 7 years, 15 years, okay? Footings and foundation is typically 27.5 years. Roofs are 15 years. Electrical could be 15 or 7 years, depending on what it is. Appliances are 7 years. Flooring, okay, lighting, cabinetry, dish. I mean, a cost segregation is going to look at all of these asset costs and assign them shorter useful life periods so that we can accelerate the depreciation on this. The reason why this is useful is because you can go and purchase 1 to 2 properties with an estimated value of $250,000 or $300,000 and capture roughly 40 to 50% of that asset cost as an expense in the year that you purchase it. So now, again, if we utilize some tax planning, we have a net operating loss from each of those properties of roughly $40,000 to $50,000 a year. So now I have an extra $100,000 in the right scenario that I can use to offset whatever other incomes I'm getting that year. Okay, $100,000 in the right tax bracket could mean you're saving an additional $30,000 in taxes. And that's how my clients who are making $5, $7, $10 million are paying $20,000, $30,000 in taxes or getting refunds. Okay, is through cost saves. Good question. Any other questions on that? That was a good question. Okay. Reverting back to the future a little bit, and I apologize, I forgot where I left off, but reverting back to the future, with capital gains, what real estate allows us to do if the real estate is held for an investment or trade or business purpose is I can do what's called a 1031 exchange. Okay. Is anyone familiar with or would like to explain what a 1031 exchange is or does or what its purpose is? There are no wrong answers. This is.
You take your capital gains and you roll it into your new property
Yeah.
within a period of
A
time.
specific time period. Really good. Any other insight into a 1031 exchange?
You defer taxes potentially.
Yeah.
Like for like.
Yeah.
Practice of like kind.
Okay. Really good. Has anyone executed a 1031 exchange? Out of curiosity here.
Personally,
Yeah.
no. I mean, I have
Any clients?
clients, yes.
Okay. So, yes, and the reason I ask these questions is because the best way to learn is to voice that, and so those are really good points. So a 1031 exchange is, 1031 actually refers to section 1031 in their Internal Revenue Tax Code. It is a code section, and the title of 1031 is a like-kind exchange, okay? So just like a couple of you guys mentioned, I can perform a trade of an asset for another like-kind asset and defer the tax. Meaning, if I were to have bought a property 3 years ago, we were dealing with, and I were talking just a little bit about this right now as it relates to your nephew, right? Not the right situation, but just an example. Had your nephew bought a home 2 or 3 years ago, theoretically, the value of that property you said would have been double the price of what it was now, right? Well, from what we talked a little bit about earlier, if you hold that asset for more than 1 year, it's a long-term capital gains, but a 1031 exchange allows you to take all of the equity that you've built into that property and put it or trade it for another property or properties, okay? What this allows us to do is it allows us to continually increase our real estate without, that's awful, I apologize, without paying a tax in any of these transactions when I sell or trade those properties. Okay. The purpose behind doing something like this is, again, in that situation, say the house was $250,000. And he sold it for $500,000. Well, now I have to pay an additional 15 to 20% on $250,000. Not including whether I've taken depreciation or not, and I'll touch on this in just a second. But I've saved, what's 15% of $250,000? 25, 30, 37.50, give or take. I've saved $37,000 in taxes just on that transaction. Plus, what I'm able to do is I'm able to take $250,000 and reinvest that back into a bigger property. What does this do for my portfolio if I'm an investor? I can diversify risk because $250,000 is 20% of what? Anyone know?
I mean,
Math.
Do the math.
20 million.
What is 20% of, or what is $250,000 20% of? Anyone know?
At 1.25.
Yeah, I don't know. It's a Wednesday. I'm not doing the math in my deck. I'm going on.
Oh, that's why you asked.
That's why I asked, because I didn't want to do the math in my head. But then but if you take 20% to get you into a property of $250,000, now I can accelerate the rate of return to be able to take $250,000 and reinvest it into a potentially bigger project. I mitigate my risk because I can either diversify that into multiple properties that have a combined bigger value of what I'm trading it for, or a bigger property with less risk because I have more units.
So with that, so what you just said, 1031 exchange, you can buy multiple properties with that.
And there are certain rules around the 1031, but as long as the portfolio value is greater than
Okay.
the portfolio value that I'm trading, you can.
Okay.
So, just for example.
Yeah.
I sell a $500,000 home.
Yep.
I want to do a 1031, but I want to get two houses out
Yep.
of it. As long as those two homes equal greater than
The 500,000.
500,000 by $1.
I'm gonna be honest, I don't know the specific, I just know it has to be greater than.
Okay.
Typically, I use a 1031 exchange intermediary.
I mean, hopefully I'm not downgrading that.
But no, you cannot downgrade, but you can increase the value of the properties.
But it wouldn't be like would each home have to mirror that home, like greater than that home, or
Just the
the
portfolio value,
combined value?
the portfolio value.
The 1031, you can't just do it on your own, though, right? You have to use
An intermediary.
yeah. a
So this is
custodian
where-
something.
This is where, in my opinion, accountants do more than what they should. I use an exchange intermediary because with the 1031 exchange, like you said earlier, Julian, there are specific time requirements. I have 180 days to complete an exchange, but there are specific time requirements to where I have a certain amount of time to be able to sell or transact, and then I have a certain amount of time to be able to identify and close on the new property, right? So there are situations that I'm aware of where an accountant will rule and file the documents with the IRS on the 1031 exchange, but I don't want to waste my time doing that, so I just use an exchange intermediary. And the exchange intermediaries that we typically use are working with the title companies to make sure that all the documents are filed correctly and the timeframes are being met and reported.
Do they hold the funds?
The exchange intermediaries typically. Ooh, you know what? I don't know if the exchange intermediaries do or the title does.
Okay. I used to
I'm
work
gonna
for
be-
Science Bank, and
I'm gonna
so
be honest, I don't know the answer to that
Okay.
question. That's a good question.
they have a whole
Nice.
1031 exchange department
Yeah,
at Science.
I don't
think
know
most
if-
things do.
I don't know if the exchange intermediary holds funds or if the title holds funds
Okay.
until that is completed. But I do work with a couple exchange intermediaries, and this is the other benefit of using an exchange intermediary, is they kind of work as a broker typically. Because there are time requirements, sometimes what happens is you'll enter into a 1031 exchange and you won't identify or you won't transact in time. So then you are subject to the capital gains. But typically exchange intermediaries sometimes work as brokers and they have different deals that are coming and going at different times. So if you don't meet the time requirements, there are different properties that you can still exchange into and hold on to those properties for greater value. So,
It was like, hey, you're down to your last. You got
hey, you got a
figure
week
this
to identify and close on a property, but here's another one in our portfolio that would still qualify. So.
It might not be what you're exactly looking for, but you could do another 1031 exchange in a year.
Yep,
or
well,
whatever.
okay, so so in order to, so let's say, using your nephew as the example again, okay, buys the property for 250, sells it for 550 through a 1031 exchange. He does have to hold on to that property for a period of 24 months before he can 1031 that same property again.
Okay.
You can use it on other properties, can't do it on a primary residence, but you can do it on other properties you own, but you do have a holding requirement of 24 months.
So each property.
Correct, when you execute an exchange. Really good questions, okay?
And it doesn't matter if you live in the property or you're renting it, just as long as you own it. 24
Cannot be
months.
a primary residence,
Okay, cannot be.
cannot be a primary residence in a 1031, it does have to be in a trade or business, okay? But yes, you have to hold it for 24 months.
And the like versus like to like. If you're selling a strip mall.
Mhm.
You have to buy another commercial property, not necessarily a strip mall, but you have to buy, you can't buy a bunch of houses.
As long as the portfolio value is greater.
Well, and.
You can't, I can't change a property for a ownership in a partnership. I can't change a property for ownership in a business. I can't change ownership in a business for a property. It's property for property.
And then. Like a fourplex is technically a commercial, so.
But I think what you're trying to communicate is that it doesn't matter if it's this or that, it's.
Single family,
You had a
multifamily,
portfolio that was worth 1.2, and now the next portfolio is 1.3.
1.3 in the
That's-
exchange.
it's more.
1.5, correct.
Okay.
Yep.
If it's a strip mall, a theater, a home or house, it doesn't
Correct.
matter, just
Yeah,
bigger.
portfolio.
It's not fun.
Yeah, not primary. Any other questions?
Or here's a
With
question.
attorney.
Yeah. On that primary, so to identify that, like I've got conventional loans on multiple investment properties that I just moved out of. Kept that loan on it, haven't refinanced.
Loan isn't gonna really matter. I can 1031 a property that I have purchased seller finance. That's, so it's not really gonna matter. Now, with the primary residence from a tax perspective, we have to be careful, and I don't know that I would recommend a 1031. If you have lived in the property at least 2 out of the last 5 years. Because you get a home for, you get an exclusion. On the sale of that home of up to 250 per individual, 500 married filing joint. So if I get the exclusion on the gain, why would I want to 1031 it when I cannot have to pay taxes and defer the gain into another property? And I can just take that gain tax free and then go do what I want with it.
Yeah,
So I'd rather execute the exclusion before I go through an exchange on a primary residence. Okay.
Now, do you have to have the same amount of debt from the property you're gonna do a 1031 exchange into? I think I heard this, I don't know.
No.
Okay,
No, but that's a good point. So please understand that in a 1031 exchange, the amount of debt you're carrying is different than the basis. And the reason that is because of depreciation. Depreciation is giving you the tax benefit now, and if I get the tax benefit now, odds are is I don't get that tax benefit in the future. And what depreciation allows us to do is it allows us to reduce the amount of income that might be taxed in a year by the cost of that depreciation. And when I have depreciation, I do have to reduce my basis in that property by the amount of depreciation I've claimed. Okay, this is why in real estate investing, a 1031 exchange is so vital, because I want depreciation. I really want depreciation. Okay, I want depreciation because my taxes are high right now. My taxes potentially are going to be higher in the future, but I want to save my money now because I can use that money to reinvest it. Okay, but by doing so, let's say I buy a property for $500,000 and I depreciate 50% of it. Okay, my basis in the property, not taking into consideration my debt, my basis in the property tax value is $250. Right, I might only have $100,000 of equity, but my basis is still only $250. So it's still valuable for me to do a 1031 exchange because I have a reduced basis and my gain could be potentially higher. Does that make sense? Any questions on that? Okay. Any other questions on future? 1031 exchange was the main one that I wanted to hit on. That was the biggest one that I think a lot of people have hiccups on. Now we get into death. Okay. The only two certainties in life are death and taxes, and I didn't want to spend my time in the mortuary for the rest of my life. Okay, so I chose taxes. Gives me more opportunity to capitalize on people. This is a smart business decision, that's all I'm saying. With death, the way the tax law is written right now is I have the opportunity with real estate. Again, we've covered there again, a couple more people have hopped on Zoom. We've covered how through real estate, I don't pay taxes now, how I don't pay taxes in the future when I transact on properties, but when I die. Okay, I said earlier that gift and estate tax rates are roughly 40%. There are some exclusions, about $11 million for a married filing joint, or excuse me, for a single individual right now. That's actually a heavy point that has been argued with tax law is should that lifetime exclusion on my death tax be given on the asset transfer. But regardless, we're facing a 40% tax when I die on all of the assets that could potentially be given to my beneficiaries. Okay, how do I avoid this? Well, the way the if you find out how, let me know. Actually, no, I'll get to a point where I'll probably just want to die. But with death, the way the tax law is written right now with real estate is real estate assets, when they are given to beneficiaries, receive a stepped up value to fair market value and basis. What does this mean? We just got done talking a little bit about depreciation and the fact that depreciation reduces my basis in all of the properties. And I want to continue to do that. I'm going to have a reduced basis as I build this portfolio out, as I get bigger and bigger, as I take depreciation deductions, so that I don't have to pay taxes now and I don't have to pay taxes in the future. The benefit of doing something like this, and this is generational wealth, if you will, is that when I die, my beneficiaries receive that stepped up in basis to fair market value. I could have a portfolio that is worth $40 million, have a tax basis of $10 million because I've taken a bunch of depreciation expenses, but my beneficiaries will receive these properties with their fair market value of $40 million. They could receive those assets, sell them the next day with the equity of $20 million and not have to pay a dime in taxes. However, if they inherit your 401k, they're going to have to maybe start taking required minimum distributions, or they're going to have to factor in taxes when those transfer over to their 401ks. If they receive ownership in businesses, then those ownership values could be taxed at capital gains tax rates with the rest of their estate that they're passing on if you don't plan right. So again, I've kind of reiterated, and I don't mean to beat a dead horse, but now I don't pay taxes because real estate should always be a loss on paper. If it's not, I'd be really concerned. Okay. In the future, I should always execute a 1031 so that I do not have to pay capital gains tax on the transfer of my properties. And by doing so, right now, again, the way the tax law is written right now is I do receive a step up in basis, so my beneficiaries do not have to pay capital gains taxes or state taxes. Question?
Yeah, so. I'm still waking up too, I still have more coffee, but.
Why don't you take a swig or two and wake up?
But, okay, so I've got 40 million in in properties.
Value.
And I've taken all these tax breaks, in the past.
Mhm.
I die. That 40 million now goes to whoever my beneficiary is.
Mhm.
And they can now do all the depreciations. Or do those depreciations transfer? Does that make sense?
Yes, because they're receiving step up in basis to a fair market value, if they inherit those properties and continue to utilize those properties, they could.
So now they can do tax benefits on it to help them out.
Again, from a planning perspective, yes, but you're receiving $20 million tax free. I would take it. And again, you're going to get a step up in basis to the property that's worth $40 million. $20 million is 20% of what? If you're going to acquire commercial loans, you can get a portfolio that's worth $100 million rather than $40 million. So why would I want to keep it? Why wouldn't I want to transact, save the tax and then put it into the $100 million worth of
Is
that?
there a time frame on that?
Ooh, you know what? I'm gonna be honest, I don't know. To be able to take this money and then sell it?
Right.
Well, the only difference would be if I inherit the money on day one and on day two, there's a $42 million. Then you'd be taxed on the $2 million difference.
So basically, you're just deferring, and then when you die,
I'm eliminating.
the deferring goes away.
Mhm.
Okay,
It's a
But if
rough day,
you-
like,
because you're on your deathbed, you're breathing your last thing, oh, I'm just gonna sell everything. Then
You
you'd
use
be-
capital gains.
You'd have all. those
You have all the
gains.
tax.
Okay,
So you really want to just transfer it?
so basically, you're working for your kids. Or-
Well,
I mean, if you wanna look at it, I'm looking at the tax savings, but if you wanna look at it that way, yeah.
Okay.
People always
I don't
talk
like
about.
them that much. I'm just
because if you
kidding.
sell it,
Then sell it, then sell it. People always talk about like the whole generational wealth idea, and I'm gonna be honest, I wanna leave my kids as little as possible when I die, just not being selfish, I just. They're gonna work for what they wanna earn. And so, yeah, we will have a rather large real estate portfolio when my wife and I pass away, but it's going to come under certain circumstances with our trusts, and they have to complete certain requirements, those are already stipulated in our trust, so those are things you can do. But essentially, yeah, I am working so that I can take care of whatever needs to be taken care of in the future.
I was being sarcastic.
No,
I actually like my
sometimes
kids.
sometimes
I need to do one of those lawyer things.
I do.
The will,
Yeah, will and trust.
yeah, I need to do that.
Any other questions? Any other questions from anyone on Zoom? Everyone's got a camera on, so they're like, or you're taking a nap, or now I know what it feels like to be a teacher during COVID. Nobody's there.
So maybe, I mean, for sake of, still utilizing your time, I mean, most of us, we want to make more transactions. How best can we utilize this knowledge to then convey that to our clients of, if you buy this house today, which is really what we all want, I mean, we want more sales today.
Right, sure.
How can we both leverage, the depreciation aspect, I think, because that is the now. And
Yeah.
clearly the future stuff, I mean, that's to a degree, it's on them. This is used to
What
allow to
happens.
facilitate connecting them with professionals like you, but teach us kind of some of the best practices, what you've seen others.
Yeah,
Take this
so if
knowledge and
I.
apply it to our clients.
I'm looking for okay, I'm gonna erase this, so. So if I were you, if I were going to sell more properties right now, and I think this is a great question to ask, especially as we. Go through the rest of this year, this is maybe just. This is my opinion, but I do think things are gonna get really rocky. The feds have clearly stated or clearly exemplified that rates are not going to decrease. Okay, for at least the foreseeable 3 or 4 quarters. I think that's been very clear, especially what happened 2 or 3 weeks ago with SVB and the 0.25% rate increase. If I were a sales agent and I were trying to still transact on more deals, even with uncertainty, I would review the passive, the active, and the real estate pro with my clients. And the reason I would do so is sometimes it's not about how much money we make, it's about how much money we keep. And if there are opportunities for our clients to be classified as a real estate pro or be able to capture loss activities as an active real estate investor, then they have an opportunity to save more money on taxes. Now, again, don't ever let the tax tail wag the dog. Okay, we never want to get into a position where we're into a property that's not cash flowing. But maybe instead of cash flowing $1,500 a month, we cash flow $800 a month and utilize our tax savings to cover the difference. Or utilize our tax savings to diversify and put into another property where we can cash flow potentially more money and eliminate some of our risk. This is, and I think if as an agent, coming from my perspective, if you were to understand passive, active, and real estate professional statuses for investors a little bit better, when you're identifying a property, if you already go into that property, knowing what your numbers are on the property, how much you're going to cash flow, what your cap rate is, maybe what your interest rate or your return on or your ROI on that property is going to be. It's easy to then plug and say, hey, do you know if you're a real estate professional? Well, if you are, here's potentially what the tax savings could look like. There's some quick estimations that we can do for like a cost segregation analysis to determine what your tax savings are gonna be. Then again, it just provides a little bit more meat on the bone and maybe provides a little bit more security to your investors or your clients when they're looking for investment properties. And whether or not they should close on them. I think it'll increase your close rate pretty good.
And it's something for you, like if we had a client, you know, that's like, hey, you know what, I've invested in one property, but I really don't understand the tax things. Me, I mean, I'm not
Yeah.
a tax guy,
Yeah,
right? So I could give them a round, broad idea and say,
yeah,
you know
just
what?
like, here's
What's your
here's
name?
the ideas, but let's go talk to Brady, okay?
Yeah.
Or again, it
Because
doesn't.
Brady
take
can
you-
get set up on multiple different ideas.
Yeah.
to help you find a plan that's.
Go over specific numbers.
Yeah, go over specific numbers
Yeah.
and help fine tune something with me that's gonna help you.
Yep.
Maximize your portfolio in the next 5 years.
Yeah. And again. Warren Buffett says quite frequently, be fearful when others are greedy and be greedy when others are fearful. I think we're going to get into a time in the next.
So we need to be greedy.
I think now is a great opportunity for you to. Maybe pull a HELOC or cash out refi and keep some of that on the side to be able to start to invest yourselves. That's. Yeah, I don't think that's a bad idea. I know I have a couple clients who are utilizing a lot of seller finance deals right now because people are upside down on properties and. So they're still transacting on seller finance deals for people that want to make some money because they're upside down on their properties. And investors are still wanting lower interest rates.
Right.
So, sorry, I don't know what your profession is. I typically in these, you're either like title or mortgage or lending or something. So I don't mean to like undermine you, but that's from an investor standpoint, that's what some of our clients are doing.
Yeah, that's a good idea.
You can come in and kick my butt later when you kind of tell them.
That just gives him more to, you know, more to give, more information to make it sell any point.
But again, I think to your question, and I apologize, I don't know.
Aaron, no worries.
I passive active and real estate professional will give you kind of a leverage with your clients to help them understand. Hey, even though rates might be a little bit higher if I go conventional, even though my cash flow might be a little bit lower, if I can strategically do so or create an opportunity to do so. Here's what your tax savings might be. To kind of, okay, I'll highlight this. I actually had a client meeting with a new client on Monday. The individual, they live in South Carolina. The guy is a sales rep for a direct consumer sales company. I think he sells solar. He's making about $750,000 a year. And his wife, they own 2 real estate properties that are probably cash flowing right around a combined $30,000 a year. Decent for 2 rental properties. His wife works at a credit union. Okay. My question was, well, how much is she making at the credit union? He goes, she's making about $45,000 gross, which means her take home is closer to what their rental income is, right? And I said, well, how many properties do you want to buy this year? He goes, well, I want to buy at least 4 properties this year. I said, okay, what's your cash flow goals on those properties? His cash flow goal should theoretically be double the amount that his wife is making. But do you want to know how much tax benefit they get from that? 0, because she's working. She's working full-time at a credit union. I said, well, I hate to break it to you, but let's tell your wife to quit. Let's create an opportunity for real estate professional status out of your wife. Okay, let's have her manage the properties. Let's have her do some of that work. You can do it with her, but at least if we can get the time and the material participation qualifications for her, then now instead of paying $750,000 or taxes off $750,000, we're paying taxes off of $100,000. We saved you double what your wife's salary is in 1 year. Does that help highlight why?
If you could actually, can you kind of also then help me with the clearly passive kind of makes sense that, you know, to convert someone from a passive to an active, because I don't think everybody's circumstance, they can become the pro. What is the methods in which someone could?
So it's all based on material participation.
Okay,
There's a time requirement, I believe it's 450 hours of material participation. And at least 100, I can, if you want to.
I'll dig into it.
If you want to email me, I'll get you the specific. I believe it's at least 100 hours more or 100 hours more a year than anyone else that's involved in your real estate. I think that's, don't quote me on that, but I'm fairly certain that that's what that is.
100 hours more than.
So if I have like a cleaner, I have to still at least provide more services for my properties than them by 100 hours. And then 450 hours at least in my properties.
So that's 450.
So. And this is going off what you just said about a cleaner, so I clean, say I spend 15 hours a week cleaning the property. That, and then I would need to come up with another 100 hours.
Not if you're doing it.
Well, we're,
Somebody has to work on that.
somebody else would need to, like if I have a client that's.
Sorry, I don't understand your question.
Okay, then I can edit.
If so you said if I'm doing the cleaning. and
Well, we
it's
could go into that, what you just explained to him just a little bit.
So
deeper.
yeah, material participation is going to include, again, it could include cleaning, management, rental. It could include looking for new properties.
Involvement.
Yes, so 450 hours to be an active participant or have material participation in my rental real estate activity. If I've got a cleaner and they spend 300 hours a year cleaning my property, I've got to spend at least 400 hours cleaning my property. Just on.
Or working.
Working in my property. Yep.
It-
Sorry, yes, you were correct. Thank you.
Passive, I've hired a management company to do everything. Active, I'm involved in that property
To some degree or another,
to some degree, 400 hours,
450.
450.
Is it in that specific property or is it in real estate activity?
So really good question, because there are elections that I can make to group all my properties together as far as they are treated tax wise, which is typically what we do with all of our clients anyways, because again, if I've got 10 properties, I don't want to spend 450 hours on each individual property. That's a lot of time, right? So we'll group activities together.
And then you mentioned 100 hours.
More than anyone operating in the business.
So really, I mean, for somebody to be active, I mean, it's truly not a. Let's try to fudge the line on it, like they truly have to be, I mean, it's 8 hours a week. I mean,
Keep
that's
some
what,
hours.
fair enough.
Any questions? Anything else? Okay, perfect. If there are, like I said before, if there are any questions, the easiest way to get a hold of me is actually probably through Instagram. My handle is Brady Slack. And then I'll put my email up here as well. That way, if you do have any questions, you can reach me through my email.
Perfect, and then we'll have you come up and introduce yourself.
Sorry, like I said, you can like come out and slide side. There we go. And I know, I apologize.
You look familiar, Shayna, right?
Yeah.
Yeah, we've done a deal or two together. I'm with First Colony Mortgage. My name is Greg. I help finance the American dream, but more than that, the name of the game right now is leads. Would we all agree? The last couple of years, I spent a lot of time, money, and coaching programs on social media. I do a lot of social media content, your typical like 15, 30, 60-second clips on how to teach or on how to build wealth through real estate, or tips and tricks on how to buy real estate. And those videos have started to convert into leads for me. And so that's something that I'm going to start teaching to agents, how to use social media to convert leads, to build your audience and your platform and build your engagement to then get leads out of it. And I'm actually going to be doing a class here next month on how to do that. So always my name and Instagram handle if you guys want to get a sneak peek. But I will be here next month to teach a full class on it. _. So that's that. Enjoy lunch.
Thank you.
Thank you.